look at life insurance as not, look at it as an asset, a financial asset. Life insurance is really a financial asset because if you don't have it in place, all that hard time that you did investing money, putting away for retirement and savings, really doesn't mean anything because you're going to have to take it over here to cover for these medical expenses, those hardships that you may have.
Yeah. And the crazy part is, life is not guaranteed, right? You're sitting here talking, 1 minute, you have no idea what is going to happen. So definitely making sure that people are protecting their assets and making sure that, you are establishing a financial wellness for yourself and that of your family. Forget when you are gone.
This is Chat Over Popcorn, brought to you by Aspire Media and Marketing, hosted by Angela Ansa. Subscribe to our social media networks and follow the conversations on Facebook, YouTube, and Instagram. Chat Over Popcorn, where the conversations run deep, starts now.
Welcome to Chat Over Popcorn, where the conversations run deep. My name is Angela Ansa, your host for the show. Tonight, we are going to be talking about how we can establish financial wellness for ourselves and our families. Joining me to discuss this very important topic is a senior advisor and owner of Legacy Wealth Strategies, Lamar Anderson. Lamar has over 15 years of experience in insurance and financial planning. And using a customized approach, Lamar helps individuals achieve financial wellness. Lamar, welcome to Chat Over Popcorn.
Thank you, Angela. I'm so excited to be here. I'm glad you invited me on your show. Obviously, really excited about the topic we're going to discuss today as well.
Good. I'm so glad to have you here. We live in a world where we are faced with so many issues. When it comes to medical conditions, medical bankruptcy is really at the forefront, right? We have individuals who are faced with heart diseases and other terminal conditions like cancer. And all of these things are really expensive, right? As far as the medical treatment. So my goal for us today is to discuss options that are available for people to tap into as far as financial resources that, whether it's through life insurance, living benefits, whatever, is out there that people may not have enough knowledge about in offsetting some of these medical expenses. So talk to us about, what is out there.
There are a lot of policies out there. The first one we're going to talk about is term insurance. Your term insurance is just that. It lasts for a certain time period, 10 years, 15, 20, 30. And most people use it for their mortgage. You have a mortgage that you take out on your home, say for $250,000, $300,000. So they get a term policy to cover that mortgage. That way, if they were to pass away during the time that they have that mortgage, it is completely covered. And then you also have whole life insurance. It's just that, whole life. Lasts for until obviously you pass. And your beneficiary could be your children, could be your spouse. You could leave the money to a church. There could be a lot of things that you could leave that money for. And then there's universal life insurance. Those policies as well last for your whole life. But what's really unique about them is they have certain investment options inside them, like a money managed account. And, we'll get into those a little bit deeper as far as how they work. But those are generally the three types that, we will talk about today and have access to.
So can you transition one policy to the next? So say you start with term policy and then now you want to transition to whole life or universal. What does the option look like?
Yeah, absolutely. There are policies out there, convertible, term policies. Now you got to make sure when you're buying these policies, you know a little bit of how they work. Do they have a conversion privilege? And that's what we're talking about. Can we convert that policy to a whole life policy, to a universal life policy? And most policies you can. You just have to see, can you do it in the first 5 years, 10 years, 15, the whole term of the policy? That's all up to what carrier you're choosing, when you buy a policy. And then most people ask, what if I get cancer? Can I still convert my policy? And the answer, yes. If you have that conversion privilege, whatever you got rated at today, when you convert that in 5 years, 10 years, 15 years, you're going to get that same rating. So that's a real benefit to these type of policies. And, with that conversion, you can convert, the full amount. So you had a $500,000 policy. You can convert the full 500, or maybe you only need 250. You just convert the 250. So it really comes down to a needs approach. And, that's something that I can assist you with as well, as finding out, what makes sense for you and your family.
So you mentioned that if individuals come down with cancer, they can convert term to whole life or universal. So there's no pre-existing condition criteria that would cause the policy to go up as far as, the premium significantly?
Exactly. There would be no pre-existing condition. What's really nice about that is, like I said, you have a major health issue, heart attack, stroke, cancer, diabetes, all these things really impact your rate. And the only cost that's going to come into those, Angela, is obviously you're going to be older. Right. So, if you buy a policy now versus 10 years from now, obviously the policy is going to be a little bit more expensive. But as far as having that pre-existing condition, that doesn't ever come into play.
So, Lamar, when it comes to death benefits, right, death is inevitable. We are all going to pass away at one point in our lives, right? Unfortunately, some cultures don't even like to engage in talking about death, right? People are very uncomfortable with it. Sometimes even seen as a taboo. So if individuals have, a terminal illness, they don't even want to talk about what life will look like after this person passes away. Right. Whereas, in the case of, say, cancer, expectation as far as how long the person may live till, right? And so, in a way, you are given a gift for you to plan adequately, right? But talking about death benefits, like you mentioned earlier, it allows people to be able to have benefits while they are still living, right? So they can use this money to, like you said, pay mortgage, other expenses and all of that, even the medical bills. I want you to talk about, since you are in this industry, in this field, and you see so many clients and you've heard and seen so many stories, elaborate a little more on the importance of getting a living benefits, right? Okay. Not just the death benefits, but living benefits while you still are alive, have a chronic condition, critical illness. Let's talk more about that. Yeah. Why should people truly consider that?
Yeah. So let's talk about life insurance with living benefits. A question could be well, that sounds expensive. We're covering all these extra things other than just death, which couldn't be any further from the truth. Life insurance with living benefits, typically in most cases, depending on the type of policy you have, are going to cost the same, could even be less. There have been situations where I've been in a home and they brought out an old policy and I've looked at it and they're paying, $100 for it a month. And I can replace their policy with a policy with living benefits for, say, $10 more a month or $10 less a month. So it's not a big cost difference. So I wanted to make sure I addressed that. But let's talk about living benefits. I mean, there's a lot of statistics out there that we could throw at you, but I'm just going to hit on a couple of them. And that is cancer. That's always the big ugly word that people, don't like to talk about. So 1 in 2 men are going to contact cancer, 1 in 3 women. I mean, those are big numbers. So if you're standing somewhere and you got someone beside you, and you're in a group of 3 of you have 2 of your friends, one of you are going to contact cancer. And it's going to be, it's just the numbers. It is what it is.
It is what it is, yeah.
Right. And then let's talk about heart disease, heart attack. Every 44 seconds, someone has a heart attack in this country. Wow. I mean, that's an astounding number. What's another one? Let's talk about strokes. Close to 1 million people a year have strokes in America. Let's talk about some sort of long-term care or assisted living. You're after age 65, the likelihood of needing some sort of assistance of care is 70%. Again, that's a big number. you're talking 7 out of 10 people, and 40% of them are going to need long-term care, and nursing facility, that type of care. So these are like real numbers. So I always tell people the likelihood before age 65 of dying is pretty rare because of the advances we have in our medical industry.
People are living longer.
Exactly.
Yeah.
So something like a heart attack, stroke, cancer, any critical illness or injury, it could even be you're in a coma from a car accident or paralysis, loss of a limb. These are all benefits where you can actually get a monetary value from your life insurance with living benefits. And I think it's something that everyone should have. It should be a large, right at the building block of their financial outlook.
Absolutely.
Because if you aren't protecting those sort of things, you can't save for things.
Right.
If you're putting money into a savings account or 401k and aren't protecting things, what happens when you get sick? You're going to have to tap into that 401k.
Right.
I have, let's just, I'm going to use an easy number like $10,000. You take $10,000 out of your 401k. What are you going to do? You're going to pay taxes, 30%, and you're going to pay a penalty, 10%.
Right
So
there,
now,
money is gone.
So now you took 10 to get
Right.
$6,000. So why not have a policy in place to protect you? Same way with chronic. Let's talk about the cost of long-term care in this area. It's generally $8,000 to $10,000 per month of cost that these long-term care facilities are. Can people afford that?
No.
So why not put a policy in place that covers all those other living benefits? You still have the death benefit in place as well. And, I want to say it covers a lot of things, but it does. It covers a lot of things.
Right.
It protects your family. Look at life insurance as not, look at it as an asset, a financial asset. Life insurance is really a financial asset because if you don't have it in place, all that hard time that you did investing money, putting away for retirement and savings really doesn't mean anything because you're going to have to take it over here to cover for these medical expenses, those hardships that you may have.
Yeah. And the crazy part is, life is not guaranteed, right? You're sitting here talking, 1 minute, you have no idea what is going to happen. So definitely making sure that people are protecting their assets and making sure that, you are establishing a financial wellness for yourself and that of your family. Forget when you are gone, right? Forget when you are gone. But while you are alive, you don't want to put financial strain on your family, on your loved ones, because once you are not well financially, that alone, the outcomes of that and the consequences that could cause on a family.
Also, people talk about getting back to cost. How much is it going to cost for me? Everybody, how much does it cost? It's always the big question. It's always the big question. And I always tell people there's so many factors. We have to take into account, male, female, smoker, non-smoker, and obviously your health, your BMI, your body mass index. These are all factors into cost of insurance. So can we get you some numbers? Yeah, we can get you some numbers, but we have to address because everything's personalized. Like I said, there's not a one fits all. Right. So if these are products you're interested in, we can get you numbers, but we can get policies for everybody.
Right.
Even if you do have diabetes, even if you had cancer in the past, there are policies out there that with living benefits that we can get. And then for our males out there, there's a lot of guys out there don't like to get their blood drawn. Traditional insurance, you have a nurse come out and they take a blood sample, urine sample, and they ask you some health questions. Most of what I deal with is simplified issue. What does that mean? You don't have to get a paramedic exam. Exactly what that means. They look at things like your MIB report, Medical Investigation Bureau. They look to see what medications you're on. They look at your driving record. Are you a good driver? Do you have DUIs? Do you have a lot of speeding tickets? And they take a look at your, is your credit good? They don't pull your credit. There's different ways that you can access people's credit. Not necessarily a number, but you get a score, based on what that is. And if all three of those in check, then you can get a policy literally like next day, 2 days, 3 days, a week. it's a really nice process,
Right.
especially during the times that we're in now.
Mm-hmm.
And I think they're great policies for
Right.
individuals and easy to get, easy access.
Yeah. And like Lamar said, they look at all these, predisposing factors. So I'd encourage you, if you are someone who's young, if you are not taking care of yourself, you want to definitely engage in that, right? Physical activity, making sure that your BMI is somewhere within an appropriate range that will not cost you a lot of money. Because I would think, it's at the end of the day, it's business. So the higher your risk factors, the more you're probably going to pay in premiums and costs and all
Correct.
of that, right? So individuals have to make their decision based on their financial situation, right? What they are able to afford. Can you give us practical example of individual who may have come down with a terminal illness like cancer? Maybe if you start out with this amount, this is what you may be able to take out from as far as living benefits while the individual is still alive versus what when the individuals pass, what money may be available to the families.
Yeah, absolutely. So what I'll do is I'll talk about the different types of insurance that are available or maybe you're most familiar with. So you have policies that you're familiar with now, which is typical life insurance. If you pass away, you get a benefit. And that's pretty much the extent of traditional insurance. I enlighten it to, you remember back in the day when we had these smartphones, or not smartphones, flip phones. Your flip phone is antiquated until what they have nowadays, which is your iPhones, your smartphones, and the new updated insurance is life insurance with living benefits. And less than 5% of Americans actually have life insurance with living benefits, which is an astounding number. And that's one thing that we're hoping to change for many Americans so we can make it different in their lives. And what I like about that is these living benefits can cover a lot of different things. The first one we'll address is critical illness, which is your cancer, your heart attack, your stroke, Lou Gehrig's disease, ALS. There's many things out there that this will provide a benefit for. The other one is a terminal illness, which you had mentioned. And what that terminal illness is you're not expected to live past 24 months.
Right.
So once you don't live past 24 months, it will actually let you accelerate your death benefit that you have on your policy, and which is something that really can help someone that's going to be in a financial situation based on those medical expenses that they're about to incur. The last one that I'll cover is activities of daily living, which is from a chronic illness. And that chronic illness could be, I can't bathe myself, can't transport myself, feed myself, or you're chronically impaired. If you can't perform any of those, it will actually provide you a monthly benefit. That benefit could be $1,000 a month, $2,000 a month, $5,000 a month. It's just based on that policy that you chose and, what your death benefit is. So let's talk a little bit about the acceleration, how you can benefit from using these types of benefits. They are, you have, your category 1 through category 4. And I kind of liken that to the different stages of cancer. That's what somebody's, very familiar with. You have stage 1, stage 4. So stage 1, you're able to accelerate, say, 25%. So on a $500,000 policy, you can accelerate $125,000 of your death benefit now while you're still living to pay for whatever you see fit. That money comes directly to you. And guess what? That money is also tax-free. You don't have to pay any taxes on that money that you're receiving. So you can use it for care, for transportation. You can use it for anything that you want to. There are no limitations. Category 4 would be basically a full acceleration of your benefit. If you have a $500,000 policy, you could accelerate 90, 95%. So when you accelerate the full benefit, then your policy obviously terminates at that point in time because you've already collected on that benefit. So hopefully that gives you a little insight, Angela, as far as the different accelerations and the amounts that you could expect to receive.
No, that makes sense. And, when individuals are faced with a terminal condition or even something as scary as losing your limbs, right? Whether it's from a car accident or whatever. Oftentimes people have so many things going on, trying to figure out what they are in shock, right? So what advice do you have for people who experience these catastrophic events, not even talking about chronic conditions, but something critical where they are just worried about making sure their family is well taken care of and all that. What advice do you have for people that go through that, and how do they go about making sure that they are secured in getting the benefits that they are eligible for through this policy?
What I do is set up the emergency response system. And what that does is allow someone that's removed from the situation. And, someone like you, say you're in a car accident and you're laying in a hospital. Well, obviously, your biggest concern is maybe just staying alive at that point in time, because you don't know what the severity is. And your husband, same deal. So the last thing they're thinking about is that life insurance with those living benefits. So we choose 3 people that are close to you. It could be anyone, a friend, it could be a parent, a brother, or sister. And I let them know what the different benefits are. The heart attack, the stroke, the cancer, the different things they cover. That way they can give me a call. Hey, Lamar, I want to let you know that, Angela was in a serious car accident. I remember you met with us. You told us about these living benefits on her policy. I just want to make you aware of that. Is there anything that I can do to help? And then that's where I come in, because what we want to do is we want to get your money as soon as possible. Right. So there's no financial strain on you. You don't have to worry about, where's the money coming from. You just worry about getting better for yourself and for your family.
And these individuals that you are talking about, those that you put on their emergency response team, they do not have to be beneficiaries to the policy, right? These are independent people who have no entitlements to the money, to the benefits. So I don't want people to think that, if you are listed as an emergency response person, contact, that you're going to be calling Lamar and tapping into that money, right?
Yeah, absolutely. That's a good question. So let's address it this way. So it's a separate form. It's a separate sheet that I have, like I said, adapted to my business. That individual is not an owner of the policy, is not a beneficiary in the policy. They don't even know how much death benefit there is, how much you're paying. They just know the different benefits that you have. That way, if something were to happen, they're there for you and your support.
What about individuals who, over the course of the years, want to make changes to their policy as far as beneficiaries are concerned? How do they go about getting that done?
Yeah, beneficiary change form, very easy. It's you can just contact me, contact the carrier, and it's just a form. You change the beneficiaries, and that's it. I mean,
so it's very easy.
It's very simple.
Very
it's not
easy.
complicated at all. No.
So Lamar, earlier you were talking about individuals who may even have chronic conditions, right? So individuals who are not able to function and like bathe themselves, cook, do the daily activities, right? Some health insurance cover for home health aides, and others don't. If you have a policy, which of the policies can you use that would allow you to get, yourself a private home care aide that can come to the house and help you, as far as mobility and, and all of that?
That's a great question. So we're talking about a chronic illness, and with those chronic illnesses, there's 5 different triggers. I can't bathe myself, I can't transport myself, I can't feed myself, I'm chronically impaired. And if you can't perform 2 of the 6, then you qualify for that benefit. It is a monthly benefit. And what I like people to know is that's not necessarily something that just happens when you get old. That could happen from an accident. You could be up on a ladder and fall off and break your neck and not be able to move. You could be in a serious car accident. So there's a lot of things that can happen that will qualify you for that benefit. And that benefit there again can be used for anything. It could be used for your care. It could be used to pay your mortgage. Because what you got to realize is when something like this happens, what happens first? You're not going to be able to work, right? So you're going to use your vacation time, you're going to use your sick time, and then after that, you're going to go probably onto some sort of like long-term disability. And then people don't realize when they go into like a long-term disability, it only covers 60% of your income. Can you live on 60% of your income?
No.
Yeah, most likely not, right?
Right. You need 100% and plus some.
Right. So this is a good way to bridge that gap. Because it could take you a year to get better, 2 years to get better, and you can use that money for just that, for your living expenses. You don't have to be in a certified nursing facility. You could get care at home. You get care in a nursing home. You could have someone certified to come in. You could have a family member help. I mean, there's a lot of different things that you can use the benefit for, which is nice. Unlike traditional long-term care, there's a lot of different loopholes and different rules and regulations. This you can use the money for whatever, because it's coming directly to you.
Yeah. So the policy don't prescribe exactly what is it the money can be used for.
That's correct.
Whatever you deem necessary that you are expending on, the money can go towards that. That's awesome. What about individuals who have, say, 401k, right? So some people think, I have a 401k, I'm good. I don't need additional policies like life insurance, whether it be term, whole life, universal. What do you have to say to that?
Well, I always tell people, there's a lot of different perceptions out there. The big thing is, I'm going to buy term insurance and invest the difference. That's not a cookie cutter, one size fits all. Everybody has different needs. If we didn't have different needs, there wouldn't be differences between individuals, right?
Right.
And so that's why there's different life insurance policies out there. And some of them we can make some really good advantages to. So let's talk about 401k. First of all, I always tell people, congratulations, glad you took the step of, planning for your retirement. When you plan for retirement, that shows responsibility, and those individuals are putting that money away. So let's take it this way. Say you make $75,000 a year, okay? And you're putting 10% of your income away. That's $7,500 a year that you're putting into your 401k. Right? And the reason we do a 401k is for the tax advantages, right? So we can save money on our taxes.
Right.
So we're going to save roughly $2,500 in taxes, of that $10,000 that we're putting in. So let's take it out 30 years. So you take 30 years, $2,500, we're saving $75,000 in taxes, investing money into a 401k. Okay? So now let's step forward. Now we're retired. Now we're going to draw money off of our 401k. I'm going to keep it simple, $75,000, right? Okay, do you agree that taxes are going to increase, stay the same, decrease? What do you think, Angela?
It's going to go up.
Probably go up, all right? So we're not going to use anything astronomical as far as a tax rate, but I just say you're going to say a 33% tax rate. So if you're drawing $75,000, 33% tax rate, that means you're paying $25,000 a year in taxes for that money.
Yeah, wow.
Okay? Crazy, right?
Yeah.
So let's take that $25,000 and take that however many years you're going to be drawing that money, right? If you're drawing that $25,000 for 10 years, that's $250,000. For 15 years, it's $375,000. So you retire at 65, 80 years from, 15 years from now at age 80, you got the number, right? $375,000 you're going to spend in taxes. So we save $75,000 in taxes, only to turn around and spend $375,000
mind-boggling
in taxes, right? So what we do is try and put that transfer, that risk, those taxes, that we don't have to pay them. So there's a policy called a IUL, Individual Universal Life Policy. And those policies have an MAA account. And what it is a money managed account. And it works much like a brokerage account. You have market-like gains, but here's the key part. There is no risk. So say you have a 10% loss in a year or a 15% loss in a year. You actually stay flat. So if there was $40,000 in there, you stay at $40,000. A really nice feature, especially when you're planning for retirement, because the last thing you want is a bad year right before you retire. Like people in 2008, our parents, we're getting ready to retire. And in 2008, we had that big crash. People lost 30, 40% of their money. And then what they have to do? Work another 10 years. Right. It's devastating. So what this does is allow people to not have that exposure to risk. And in most cases, actually outperforms the market, because when you can take out those big negatives and just make it a zero, that is a plus. And we take the money out as a loan, and then the money is tax-free.
Oh, yeah.
So it's a tax-free income. And that's beautiful because you don't have to report it on your taxes because it's a tax-free income because it's coming from a life insurance product. It's a great way to supplement what I call retirement savings. 401ks can be great for some people. You know, if they're, let's say, getting matched by their employer, you're getting free money. Yeah, that makes sense.
Absolutely.
But anything over and beyond what your company is matching, you need to look at different avenues to put that money.
Yeah. And when it comes to financial wellness, you know, you are not only looking to make sure that when you come down with an illness, right, that is on the most extreme part. But if you have family, like kids, right, when they grow up, they hopefully going to go to college.
Sure.
So let's talk about what options are available for families who have young kids that definitely want to invest in their education, making sure that when they get older, you know, 17, 18 and ready to enter college, that college is expensive, right? There are some, you know, available benefits that they can tap into to go to college.
Yeah, absolutely. So what I would recommend people to do is get an IUL on their child. So you get an IUL on the child. So it covers a lot of different things then. You know, if you get it right when they're born or shortly after, within a year, you know, you have 18 years to grow their money. And then again, they get to take it out tax-free. Say they don't go to college. You know, not everybody goes to college or is fit for college or they change their mind.
Right.
There's no penalty, you know, for having to withdraw the money. You know, if you're in a college 529 plan, you know, if you don't use the money for college, then you're going to have to pay taxes on that money.
Okay.
So if you're in IUL that doesn't have those tax consequences, you can use that money for whatever you want to. If they don't go to college, they could use it for a down payment on a house.
Yeah. So
start a business, whatever they want.
Yeah. Can the child go and take out the money, or the parents has to be the one to take out the money?
Obviously, before 18, the parents will be the owners of the policy.
Okay.
So at that point in time, then they would initiate any withdrawals. Like a kid didn't just go in and take $10,000 and go blow the money.
But as soon as they hit 18, then they are entitled to use the money however they see fit.
Well, you would still be the owner of the policy. You would actually have to transfer ownership over to them.
Okay.
So they still couldn't go in and get that money. So
until you do that.
So you would still have the control. Correct?
Okay. Yeah. But what about in the case where you, God forbid, are incapacitated and you cannot do it? If you don't, you know, when you are cognitively aware and you do not change it for the kid for whatever reason, can the kid, when they hit 18, go and get the money themselves?
Yeah. So when you're the owner of the policy, and you're obviously cognitively impaired at some point in time, you're going to have someone that is your caretaker or signs stuff for you.
Proxy, yeah.
So that person there would just sign that policy rather than to the child.
Okay. I'm sure many people are thinking about this. What about if your healthcare proxy maybe have personal issues with your child and want to punish the child, and so they would not do the proper paperwork to make sure your child get this money? At that point, what does the kid need to do, right, to make sure that they get the money? What is the kid's option?
Honestly, I don't know.
Okay, but you know, I'm just thinking that some people, people have personal beef with people for
I would say
whatever
make a better
reason.
choice for your proxy, maybe.
Yeah. Get yourself a better proxy. If this person you cannot trust, just don't put anyone as a proxy when they cannot be, you know, advocating for you when you are no longer in a position to do so. Yeah, okay. In the case of a death benefits, when an individual passes away, how long does it normally take for the beneficiaries to get the money?
A couple of days.
Couple of days. Wow, that's fast.
It's not long at all. Now, that's based on when the agent that you work with knows. I mean, obviously, when you die, you know, if the agent doesn't know, he can't, you know, process the proper paperwork. So as soon as it's processed, you know, it's a couple of days, you know, within a week or so. Yeah, it doesn't take long at all.
Yeah. So the individuals, but the beneficiary can call process it or call, in this case, the agent
correct.
to get it done.
Yeah.
Okay.
And that's the one thing nice is having a named beneficiary. You know, life insurances have a named beneficiary, so it goes directly to that person. It doesn't have to wait, say, for a 401k where it will just go into your state, and then you got to wait till your state settles. This goes directly to the named beneficiary, which is nice because then you can pay for those funeral expenses, you know, memorial service, you know, etc.
Are spouses automatically the beneficiary for individuals' life insurances, or the spouse has the option to choose whoever they want? Let's say, you know, you are not really on good terms with your partner. And so you don't want your partner taking the money, right?
Right.
Getting the benefits.
Yeah.
Talk to us about what couples' options are.
Yeah, that's a good question. And so let's say you're an owner of a policy, right? So you're the only one that has the rights to make any changes whatsoever, whether it's a beneficiary, whether it's premium, whether it's your death benefit. The spouse doesn't have any ability to change the beneficiary, take money out of it. The only person that has any ability to do anything with the policy at all is the owner. So the spouse is not automatically the first beneficiary. It's whoever you name as that beneficiary. It could be your sister, it could be a parent, it could be your child.
Okay. What about in the case where the owner does not list a beneficiary? What happens then?
There always has to be a named beneficiary when the policy is issued. There always has to be a primary.
Okay. So even if you don't have kids or anything, pick a church, pick an organization, charity, something. Is that how it works?
It has to be insurable interest. Okay. So obviously, you know, if you want a policy, you know, what's the policy for? You know, if you have a named beneficiary, what is that beneficiary's insurable interest? You know, I just can't make it be a friend of mine.
Yeah.
You know what I mean?
Yeah,
there has to be some sort of relationship there.
Oh, okay. Okay. So it has to be like a relative.
Yeah, a relative. I mean, it could be a fiance. You know, that's not necessarily a relative, but a fiance could be a beneficiary. But yeah, it has to be a parent, a child, a foster parent.
Yeah.
You know, it has to have some sort of insurable interest there for there to be a contract between the two parties.
So how do you verify that? If, let's say I want to use my friend, I mean, how would you know, as an agent, how do you verify to make sure that individual that I'm using as a beneficiary is a relative?
Yeah, right. So when you put down the information, obviously, you know, it's going on my integrity as well as your own, as far as verifying the information. So if I put down Joe Smith, then I put down, is he a parent? Is he a grandparent? Is he a child? You know, what's the relationship to the insured?
Right.
And here's one thing while we're talking about beneficiaries is there's this thing called a contingent beneficiary. So you have your primary, which is the first, and then you have a contingent. So let's say you and your husband, you have life insurance policies, right? And you're his beneficiary, and he's yours. What happens if you're both in a car accident? Where do those policies go?
Your kids, I would think.
Right? They'll just go into your estate.
Your states.
They'll go into your estate. So what does that mean? Now the death benefit becomes taxable because it didn't go to a named beneficiary, it went into your estate. So you want to have a contingent beneficiary. That contingent beneficiary you can name as a parent, a trust. Could be children of the insured. You could actually name your children if you want to. But that prevents that from having to go into your estate and become taxable because obviously, you know, accidents can happen and you could potentially both pass in that accident.
In the case of an accident, the benefits don't automatically go to the children of the couple?
No.
Really?
No. It would go to your estate, and then obviously they would get the money that's in your estate, but there'll be quite a process and settle in your estate to actually get to that point.
I'm even learning a whole lot just talking to you about this. Here I am thinking I'm asking for the public, but really, wow, that is interesting. That is interesting. Okay. So, Lamar, can individuals have more than one policy?
Yeah, absolutely. Because people's needs change. Just like if you were to get a policy now, that covers your needs today, because that's all you know is your needs today. Say your family grows and you need more coverage to replace income for your kids, or you get a bigger house and it costs more money. So you can add policies. There is no limit. You could have 1, 2, 3, 5. But yeah, to answer your question, you can have more than one policy.
Good. With different carriers, same carrier?
Yeah, could be with the same carrier, different carriers. Because at that point in time, you're taking a carrier or choosing a carrier based on what your needs are at that time.
Right. What about individuals who may think about using their insurance policy as an investment? Would you say that's a wise decision?
Yeah, I mean, life insurance can be used for a lot of different things. I think insurance is a great asset to your financial outlook and can be used to create a retirement savings. Not a full retirement savings, but something that supplements, comes alongside. Because obviously you probably participate in a 401k, or if you're medical or a government employee, a TSP, things like that. But this is just to come alongside and really enhance your retirement, because you don't want to have all your income taxable when you retire.
Right.
You need to have some tax-free retirement savings. And other thing to keep in mind is, say that you do well for yourself, you, for whatever reason, put a lot of money in your 401k, and you think, I'm going to retire early. I'm going to retire at 50. Well, guess what? You can't access those 401ks without a penalty early. So being able to access the policies with like an IUL, you can access them at any time. Money's available to you right away. So, those are some benefits there.
Good. So before we let you go, Lamar, I want you to talk to our viewers and just share a piece of advice. Having been in this industry for so long, you've seen a lot, you've heard a lot. Talk to our viewers as to why they should consider it.
Well, as far as life insurance, it's a very good tool to protect your financial history. Because if you look at the building blocks there, you don't buy a car without having car insurance. You don't buy a home without having homeowner's insurance. So you shouldn't walk through life without having life insurance. You're protecting you, the biggest asset to your family. And, that's how I would look at that. If you don't have any insurance, or you do have insurance, what you need to do is take a look at what you have. Sometimes people forget what they have. It happens to my clients all the time. I'll sit down with them and they're like, oh, I have $100,000 with ABC company. I'm paying X amount of dollars for it, and I got it for another 20 years. And we need to find out that they had $50,000 and it's going to end next month. Those things happen all the time. So, pull out your policies, take a look at them. I do free reviews of your policies. I can do that either sitting down with you. We can do that Zoom through a call. I make it easy for clients to really get a good footprint of where they are, because we can't carve a path, get someone on roadmap to future if we don't know where they're at now.
Exactly.
So once we get a good idea of where people are now, then we can paint that path, for their future.
Very nice. Thank you.
You're welcome. So glad to be here, and look forward to next time.
Good. I can't wait to bring you back, because
right.
I'm sure we haven't even uncovered everything when it comes to financial wellness, right? There is Medicare benefits, wealth management, all other stuff, business people, right? That's another thing too. So hopefully we can bring you back and talk more about, just how people can better protect their assets.
All right, great. Thank you.
You are welcome. Wow, Lamar. Well, what an amazing conversation this had been. I'm hoping that our viewers really learn a lot. Talk to us about how we can get in touch with you. If somebody out there watching us today, I like what Lamar is saying. I want to give this guy a call and, get a policy in place. How do people get in touch with you?
Yeah, absolutely. There's a couple of different ways. Obviously, you can contact me personally. I'll give you my direct line number. It is 717-887-0810. You can contact me via email, via social media. I don't have anything blocked, so you can add me to whatever social media platform is out there. Obviously, you can go onto our website at Legacy Wealth Strategies and contact us there as well.
Wow, Lamar, thank you so much for engaging me in this conversation. I personally have learned a lot just talking to you right now, and I hope our viewers have also learned a lot. remember, financial wellness is exactly what it is: being well financially and making sure that you are not, putting yourself in a position where, because you did not know of that information, you are putting a strain on yourself and that of your family. Again, thank you for watching. And remember, our truths are best lived when we dare the moment. Until next time, take care.
Thank you for watching this episode. To continue with the conversation, subscribe to our YouTube channel and click the bell or notification button to be notified every time new videos get uploaded. Also, click thumbs up to like the video and follow our Instagram and Facebook pages to catch up on all the conversations.